not sure if I'm recording. There we go. Just for those who can't attend, we'll put it up on our YouTube page so you can listen in. But thanks for joining tonight. Obviously, most of the attendees, usually who attend these conferences, it's very similar. It's our clients, most of whom which haven't been with us a very long time. Usually it's newer clients too, and then also prospective clients who are kind of looking at our strategies and seeing what we're doing and what our thinking is. I think people get bored of hearing me after a few years or 10 years, and they stop tuning in. So with that, I'll try not to repeat myself. And I thought I'd talk about, usually I never plan anything. I usually try to talk topical. I did a little bit of planning. I thought I'd talk about one stock in particular and one bond in particular as exemplary. I'm going to focus more on fixed income. And what time is the debate tonight? Is it at 8? I'll try to get done before 8, or is it 9?
8:30.
8:30. Okay, so we'll definitely be done before then. So it should be an interesting debate. But I thought I'd start with our strategies. You know, right now we're 3-star rated by Morningstar. We've been 4- and 5-star rated, and I'm sure there'll be times when we're 2-star rated. The market's always going to go up and down. Our strategy is always, we'll have years like 2013 when we look like geniuses, and then we'll have years like we look mediocre like 2014, and then we'll have years like this year where we might be lagging behind because value stocks are out of focus or high yields out of focus. But the most important thing for our clients is to get you current income. So we've been through a lot of ups and downs over the last couple of decades. I've been doing this, coming up on 19 years now. And but the green triangles is your income. Now my income is dependent on these ups and downs. I get paid at the end of every quarter unless you fire us. And then secondly, based upon the portfolio value. So when we go to these downturns, you know, Altrius loses money, but your income stays the same, because I know, like most of the individuals who are on this call tonight are retirees, and you need regular income, and this is just that. The income is going to stay stable for you. So a client with $1 million, you know, 12 years ago, it's nice that we've more than doubled our client's money. But it wasn't a straight line getting there. It was a very rocky road. I mean, if you look at it, we really did well here for 4 years, and then it was all taken away, and then we've climbed back after a couple of years, and now we've done well again. But again, the important thing for our clients is that none of our clients panicked during a horrific downturn. I mean, the financial crisis was really bad, because our clients just kept taking the income, and the income's been steady for them. Those clients who don't need income, well, we're reinvesting these dividends and interest at lower prices during these dips, and that really increases the income, which is kind of what the next slide shows. I mean, this is the nice thing for our clients, is not only have we doubled their money, but we've more than 2.5 times their income potential. So, you know, if they started with us back in 2003, they were receiving about 4.5% a year in dividends and interest, which equaled about, on $1 million, equals $45,000 a year. Well, today you can see they're getting $90,000 a year if they reinvested all of their dividends and interest along the way. Now, some of our clients took the income as they're going, and their principal still greater than $1 million. And at times it dipped below their principal, but those were just paper losses. And the paper losses is exactly what I want to talk about today. Because when you have stress situations, right now I sent an email to my neighbor here. He literally lives, Jim Cramer lives, you know, 4 blocks away here, not far at all. And he's a very personable guy, but on television, the goal of CNBC is to tell you what matters right now means something and is imperative. And the reality of it is that that's not true. So I sent an email to CNBC, attention to Cramer, saying, hey, tell him to calm down, because he's scaring investors and making, you know, people think that that a crisis in high yield is a crisis for everyone. So just to kind of, I thought I'd pick out one bond in particular to talk about tonight. And actually, I'll first just give a quick overview too of the markets here, just for the year. So year to date, there's been a massive dislocation in that if you look at the U.S. stock market, it's not down that much. You know, the S&P 500 is down a little bit. The Dow Jones is down 1.5%. It's not that bad. However, international stocks, you can see growth international stocks are down about, 4%. And then value international stocks are down significantly. The value is this EFA right here, this light blue-gray color. And you can see that's down 9% for the year. High yield and junk bonds, you can see HYG and J&K are down 10 and 12% significantly on the year. And then dividend-paying stocks, like we like to purchase, is also down about 5% for the year. So we just went negative. We're down about 4% right now for our U.S. stocks. Our international stocks are down more with the international sector right here, and high yield's down also with high yield. So everything's kind of gone negative for the year here in the last couple of weeks as you see this massive downturn. And again, to kind of focus on, most of the time you just hear about U.S. stocks here in the United States, and the last 5 years in this massive divergence between U.S. stocks. If you look at a 5-year chart, you see here's U.S. stocks. Let me highlight in dark blue. U.S. stocks have way outperformed. If we look at international value here, you see the international stocks, it's really amazing. International stocks have lost money while U.S. stocks have gone up 62%. Now that's a huge divergence. Normally what you see over time is these things will cross again. You'll see U.S. stocks will now start to calm down or maybe go down a little bit, and international stocks will finally recover. And you kind of see that if you look at a 10-year chart even. You'll see that the divergence is not as large, but still quite large. Here again is, if you look at the international index, or worse, international value stocks, way down here at minus 22%, and then the Dow Jones and the S&P 500 up at 61%. So this is huge. Now I've been writing a lot the last couple of years that it's time for us to move into international stocks. Is this the right time? Well, we're still at, right now, we're at about 35% in U.S. stocks right here. Excuse my handwriting. And we're at about 20% international. Now, years ago, we were at 45% U.S. stocks, and we were closer to 10, 12%, somewhere around here for international. So we've almost doubled our international exposure, and we've reduced significantly our U.S. exposure. And then we've also reduced our equity exposure, because we were at one point, we were at 65% equities, and then we'll sell off stocks and buy more bonds, and trying to reduce risk and selling the winners. So that's what we're doing from an asset allocation standpoint also. It's quite likely, again, that we're going to see international stocks, because over time these things tend to converge against themselves. And that's certainly been the trend. And again, if you look at the last, say, 2 years, it's the same story, where U.S. stocks are still positive, not by much, but still positive. Not, this year they've gone negative, and we've done well. Our stocks have done right around 14% over the last 2 years. Let me give you an exact number. So for our clients, we've done, this is a 2-year, yeah, from December 14th of 2013, which was a huge year for us. And so I'm not showing the big year we had. I'm just showing from December 14th, 2013 to December 14th of 2015. You can see we've done 14.8%. So we've done better than value managers, because most value managers, as you can see, are in this sector right here. The IWD is the red line. So most value managers have just been right in this section right here. So we've about doubled the return of value managers. We've gotten about the same return as the S&P 500. And again, sometimes clients will say, or investors, especially institutional investors, did you beat the indexes? And as you can see just from these I always say, what index? There's 10,000 indexes out there. There's we're not about beating the indexes. We're about getting our clients a prudent rate of return with a certain amount of risk. I'm trying to actually equal the market's return from the stock side with less risk and get our clients current income. Because the problem right now is if you put the money in a bank or in a treasury, you're getting a 2% rate of return from a 10-year treasury. And if you put it in the S&P 500, you're only getting like a 1.8% dividend yield. It's just not enough for our clients to retire on. Again, you can see over the last 2 years, international stocks have performed very poorly, and high-yield bonds have performed very poorly too. So again, next year this could be completely reversed, and clients will ask, Jim, why didn't you put us 100% into international stocks or 100% into high yield? And the reality of it is that's not prudent money management. We want to own Nestle, we want to own Royal Dutch Shell, we want to own Total and Unilever and Diageo and great European and great Japanese companies like Canon and Taiwan Semiconductor. And then we also want to own great U.S. companies like Exxon and Chevron, Microsoft, Apple, and so on. So just giving you a brief outline of what's happened from this year, that's kind of the divergence in why balanced portfolios over the last couple of years have only been relatively flat. Even prospective clients will say, oh, my current broker or my current advisors only made me 4% over the last year. And I always say, that's about right. That's not, don't fire your broker because of that. Fire them because of service, or fire them because of strategies not applicable to you, or they're taking too much risk. There's years when we'll be right in the middle. I'm never going to promise you returns. I can't legally. And it would be disingenuous for me to do that. I think I'm very competitive, being a former boxer and former Marine, but and try to beat my friends, especially those up here in New York who are some very bright minds. And we've done it over long periods of time, but who knows what the next decade does. I'd rather just get you a prudent rate of return, invest in good companies where we can get a decent rate of return. So that's exactly what we're focusing on. So in that vein, I wanted to kind of talk about one stock and what's going on in the high yield bond market right now, because you're hearing about these distressed companies. So I thought I'd talk about Rent-A-Center, which is our largest holding in our bond strategies. And Rent-A-Center, let me take this away here and pull up this chart here. So this is Rent-A-Center over the past year. Now, fortunately, we don't own a stock, although we might. Stock's getting a bit intriguing at its current price. So you've seen this massive sell-off in the stock price of Rent-A-Center. Now, some people will say this is an opportunity. You can see there's a massive sell-off occurred right here. And a lot of times people ask, well, what caused this to happen? A couple things happen at this time of year too. Is Rent-A-Center's earnings are actually not good, not that bad. They're actually above what they were projected to do. But when a company, it's kind of like if Altrius, if we come out and I say, hey, our earnings were great this year. We earned 5% better than we earned last year. Now, my next breath during my conference call to our shareholders, if we had shareholders, would say, but our guidance next year looks terrible. The economy looks bad. Our orders aren't good right now. We're having a hard time with getting new clients or whatever. If I happen to be really negative during the call or think my guidance is bad, short-term Wall Street, which is very close to where I live here now, is very short-term. And what they'll do is they sell off. These are the momentum guys. And what they're trying to do is playing the fool's game of getting in and out of stocks. This is everything you see on CNBC, whether it's Fast Money, all of those shows are based upon ramming into a particular stock and chasing it and or shorting it too on the downside. So you'll see pile on. This is what's happened here. The stock went down 20% in a day, and every hedge fund manager who might be long Rent-A-Center's competitor Aaron's and short, meaning they expect the stock to fall off. I actually had one of our interns from a couple of years ago, who's from MIT, do an analysis on this, and it showed almost exactly that when a stock was selling off, short interest was going up, almost perfectly correlated. It's the same thing when a stock is going up. Wall Street is chasing it. The problem with that mentality too is kind of like with McDonald's or Chipotle, to give you an example of, so we own McDonald's, and everybody hated McDonald's, including my neighbor here, Jim Cramer, who was just bashing McDonald's, saying that, you know, it's a terrible company, it's run terribly, and you got to own Chipotle. And clients would ask, like, and frankly, from an eating standpoint, you know, Chipotle may be healthier if it doesn't have E. coli, right? So they've had that E. coli scare recently. And then a McDonald's hamburger, which now supposedly meat gives you, you know, cancer. So, you know, we can't eat any meat. Although we look at it and say, all right, we owned McDonald's for a long time. We did very well at McDonald's. We exited McDonald's when it was a few years ago, when it hit about 100. And at that point in time, McDonald's, I believed, achieved full value. And we bought back in at about $96. And if you look at like a 10-year chart here of McDonald's, compare it to, say, the S&P 500, or even a 5-year chart. Now it looks, you know, it's only going back. It's not doing 10 years for me here. I'm not sure why. Yeah, maybe it is. Let's see. Yeah, it's going back to 26. Okay. So at this point, it hit 100, and it really stayed at 100 for a long time. McDonald's wasn't, you can see here, this is about when we exited. Yeah, it was right at about 100. And it's very rare that I'll pick it perfectly. And then for years, McDonald's just stayed at that price. Everybody hated it. Yet their earnings kept going up, and their dividend kept increasing. So we re-entered the position at not great timing. I think it was January of last year, somewhere right around there, January of 2014. And of course, the stock sold off, and we were value investors. And what we're doing during that time, if you look at like the last, say, 5 years of McDonald's, is we're buying on these dips when it goes down from the price we bought it at. We're using the dividends to buy more shares. We're selling the stuff that's gone up. And interestingly, if you put Microsoft, which we've owned throughout this whole time, if I did a chart of Microsoft here, you'd see that Microsoft is a company that we've owned for a long time, and it's gone through. Everybody hated Microsoft, and I did too. I was so frustrated with it for years. It just underperformed. You can see Microsoft is in the green line here, and for years it just underperformed and underperformed. But we kept buying it and stayed with it, and now Microsoft finally, and believe me, 5 years, this period of time here feels like an eternity. I mean, think about it, quarter to quarter feels like an eternity if your portfolio is down or a particular stock is underperforming. And we as Americans are just impatient as it is. However, our clients kept getting paid a nice 3% dividend as we owned Microsoft during that time, and we're getting paid to wait. None of our clients had to sell shares of Microsoft. Unless our clients are taking out 5 or 6% a year, they never have to sell a share of Microsoft, because they're just simply collecting the income from Microsoft or from McDonald's. And as they're collecting the income, the stock price is going to go up and down. It's going to scare them when it goes down 10% or 20% like it did here during this downturn, which, you know, doesn't look like much now when you can look at a 10-year chart or a 5-year chart. But as you're going through it, it's pretty scary. And I can't tell you how many clients ask us, why don't we own Chipotle? And just to show you, McDonald's versus Chipotle. And we're not growth managers. It's just not what we do. We just don't own Chipotle. So over the last 5 years, Chipotle has way outperformed. And this is what growth guys will do on Wall Street. They'll chase performance. The problem with this, and if you held it back here and you paid 100 times earnings or 50 times earnings. I mean, think of it this way. That would be like somebody offering to pay me $50 million for my firm. I plan on having a heart attack at age 100 and something, hopefully doing exactly what I'm doing right now, because I love doing this, and kind of like Warren Buffett. And to me though, if somebody offered me $50 million or $100 million because they look at our business and say, well, yeah, but Altrius is growing so quickly, and your client base is very steady, and you know, we want to invest in you, we're willing to pay any multiple, it's hard to pass it up. And what happens is performance momentum chasers just keep pushing that stock up, and it becomes a greater fool theory. But the market is people will still, the end justifies the means, but the problem with that is, and if you look at a shorter term chart, you look at Chipotle over the last year, this is the problem with growth, is that growth can really work against you very quickly. And Rent-A-Center is actually in that same boat, you know, when you pay too much for something. So this is exactly what happened in Chipotle. And of course, everybody hated McDonald's, and Chipotle was outperforming McDonald's until all of a sudden it didn't. Now McDonald's looks like a brilliant move on my part. Now I'll make plenty of mistakes. The good news is I don't have to be right all the time. But this is also the difference between a growth investor. So a growth investor is chasing momentum. He's chasing, watching CNBC every day and saying, and unfortunately, as you can see behind me here, I'm watching it too, or Bloomberg right now, I think. And you know, growth managers are trying to chase, but that's a fool's game, because you're trying to guess where the market, where the herd is going, and that can change in a moment's notice. Value investors, who are very few and far between, actually. I mean, Warren Buffett is always touted, but value investing is very hard because it's hard for two reasons. One, it's hard to hang in there when a stock is getting banged around, and sometimes cheap stocks become cheaper, right? So McDonald's can become even cheaper. And then the second part of value is you can get fired by clients, because they'll say, you know, Jim, why are you in McDonald's? You should be, you know, Google or Chipotle have done 100% over the last year. You should have us in that. But Chipotle isn't a global company. Chipotle isn't priced at a reasonable valuation like McDonald's at 50 times earnings. And Chipotle isn't paying you, our clients, a dividend. So it's higher risk and not necessarily higher return, as you could see from the loss of 14.5%. Just as everybody was piling in, people start piling out. And clients would have been better served by just buying boring old McDonald's and boring old Microsoft, which we've owned. And by the way, this doesn't include the nice 3.5% dividend yield. So the return is not just the 27.5%, but also the dividend yield that our clients have received this year. So that is in the crux of the difference between a value investor and a growth investor. And we're clearly in the Warren Buffett value camp. But value investors get fired a lot by their clients, because you have to sit through periods where you by nature are going to underperform, because you're buying the stuff that everybody hates. You're buying the stuff that nobody likes. Or as Warren Buffett would say, the really discounted stuff, the deeply distressed stuff, the cigarette butts that people throw away that still have some puffs of life in them. Now, we don't have too many stocks like that, but we do have bonds like that. So I wanted to give you first a growth versus value overlay, and then move into the bonds and what's going on in the bond market. Now, if you're, so if you look at, say, let me take this down and look at our bond portfolio right now. Let's see, where is it? Here it is. No, that's not it. No, it's in here somewhere. No, here it is. No, it's not it either. Let me pull up our whole bond portfolio here. Do a quick report. And by the way, anytime you need a report, just call us, because there's like 10,000 different reports we can run for you. So right now, all I'm running is a report of all the bonds we own, which, by the way, I own the same stocks and bonds that you own in your portfolio. When we sell a particular stock or bond, we buy, you know, $700,000 worth of Rent-A-Center. I'm buying that in my own personal portfolio too, and we're buying it in the Altrius profit-sharing 401k plan. So all of our associates also own these bonds and stocks inside of our own portfolio. So we're fully vested right along with you. So to bring up Rent-A-Center as an example, so we paid about par value. You can see we paid about $100, a little more than $101, almost $102 for Rent-A-Center. And at that point, our yield to maturity was about, let's call it 6.5%. Kind of keep the math simple here. So we know as long as Rent-A-Center doesn't go bankrupt, that we are going to make a 6.5% rate of return. Now, with that, the price of Rent-A-Center is going to fluctuate. Not, if you look at, it's a go back to Rent-A-Center's chart here. Back to the chart here. So this is what's happened with the stock price, right? The stock price has fallen off a map. It's gone down 57%. The bond has gone down this year too. If you look at the price of the bond even you look at the last 2 weeks, and this is the stuff we're looking at when we buy bonds for your portfolio, you can see that just 2 months ago, so 30 days ago, if you look at the price here back on October 15th, the price of Rent-A-Center was stressed a little bit, but not much, about 95. So we call that a discount in the bond world. So 100 is par, 95 is a discount. Now a premium is 103, right? So that would be, or 102, which is our average cost. But we know if we pay $95 for it, that we're going to make a 7.6%, 7.7% rate of return, because we're going to make money 2 ways. We're going to make money, one, when this bond comes due in 2020, because Rent-A-Center is going to give us $100 back, right? Or really 1,000. So most of you may own 0.5% of Rent-A-Center. That's the other thing, is we don't want to put too much in Rent-A-Center. You own about 80 to 90 bonds inside of your portfolio, because if one goes bankrupt, which we know we're going to have bankruptcies, especially in the energy sector, and over time we're always going to have bankruptcies when we're getting a 7 or 8% rate of return. The par value is at 100, and so we're going to make about a 5% differential in price, or 1% per year, and we're going to make that coupon, which is 6 5/8 or whatever the coupon's at. So we're going to make money in 2 ways. Now the second part of this equation is the price is going to fluctuate just like a stock, not quite as much. So Rent-A-Center's price hasn't gone down 50%, but it has gone down 20%. Now, value investors like us, or vulture investors like us, we say, hey, this is a value. We don't think Rent-A-Center is going bankrupt. Now we're going to make money in 2 ways. We're going to make we're going to make money on the current coupon, which again, if you look at the coupon on so if you owned $1 million, if you had $1 million portfolio with us, if we had 1% of your portfolio in Rent-A-Center, we'd have $10,000 in it, and it would be making a coupon of 6.625. So you can see that yield is right here. Let me get my pen out. So it's 6.625 is the coupon. Now on your $10,000 bond that you own, you know that as long as Rent-A-Center doesn't go bankrupt, they're going to pay you $662. It's hard for me to write with a mouse, but I'll do my best. And 50 cents, right? So that's what you know, and they're going to pay you twice a year. Let's say they pay you in January, they pay you $331.25, and then in July they pay you the other $331.25. And they'll pay you twice a year. Some will pay. Usually it's semi-annual. Now the bad thing about bonds sometimes too is that they get called, which is a double-edged sword for us. We always love that we get paid back, but the problem is we lose that nice 6.625 yield. And remember, we're making money in 2 ways. We also, right now, if we bought Rent-A-Center, we'd only pay 82 cents on the dollar, so we would make another 18%. So when you take that 18% over the next 4 years, plus the 6.25, that gives you the yield to maturity of 11.3%. So if Rent-A-Center doesn't go bankrupt from today, you, our clients, and me, who owns Rent-A-Center in my portfolio, is going to make an 11.3% return per year. Again, now we also have to recover the 20% that is down, but we're still going to make a decent, prudent rate of return from the original purchase price we bought it, which was right around 6% a year. So the only time we lose money is twofold. One is if our clients force us to sell. So if they start taking out too much, whatever that is, again, it's your money. We just advise our clients on a prudent distribution rate, which is usually 4 to 5% a year. But if you said, I want 10% out this year, now I'm forced to sell something which could be up or down. And if I had to sell Rent-A-Center today, then I'm a forced seller. And when there's a panic and high yield market right now, you can see that the purchase prices that are out there. So this is what people are willing to sell at. So this could be, there's 45 out there. This could be a broker in Chicago, and his client is panicking. And his client has said, "Get me out." Or this could be a broker in Chicago who said, "I just want out. The bond's down. Oh my God, my client's panicked. They want the money out." Well, what we do as value investors is we say, "We're happy to take that off of your hands, Mr. Chicago Wealth Advisor. We're happy to take that off your hands, Mr. New York Merrill Lynch Wealth Advisor. This guy's he's got 23. This guy's got 21 to sell. This guy's got 68 to sell." We're usually buying all of that, right? So we sit in there and say, you know, we're talking in our morning meetings, Zach and I are talking, and we say, "All right, Zach, hey, buy up all of that. Buy up all 200. Let's say 200 is available. Let's buy 200. Now, the painstaking part for us is we're not just chucking you in a mutual fund. The painstaking part of that is I got to put 2 of that into my portfolio. And then we're going to put, you know, maybe Doug, you've got 10, and now we're going to put 2 more and bring your position up to 12,000. Or, you know, each portfolio, we don't want it to be more than too much in any one particular stock or bond. So that's what we're doing on a daily basis inside of, from a cash flow standpoint. Your portfolio, Rent-A-Center and McDonald's are pushing out cash and dividends. Some of our clients are taking that cash and dividends to live their lives in retirement. Some of our clients are reinvesting that, and we're buying more shares of the stuff that's beaten down. Or we're buying stuff that, you know, we're selling Apple because we've made 60, 70%, and now we're buying something that's beaten down, maybe like IBM or something like that, which we don't own right now. And that's the idea behind value. So when you hear that the high yield market is stressed right now, or if you're Third Ave Value, which is a famous mutual fund family right here in New York, well, Marty Whitman, who founded the company, they're managing billions of dollars. We're not managing billions. So when we have to sell, even if you force us to sell, your position is liquid. Now, I'm only going to get $82 for it, but I'm not going to be stuck with it. Now, if I was trying to sell, think about if I was trying to sell $1 billion, like this guy right here. Here's $1 billion. That's 1,000. Remember, it's 1,000 times 1,000. So that's some wealth manager who's trying to get rid of his position, and he's trying to get rid of it for a couple of reasons. One, he might be getting rid of it because he doesn't want to show that he made a mistake in his portfolio. Again, my mistakes are always out there for our clients. You own the individual stocks and you own the individual bonds inside of your separately managed accounts. We don't pool all of our clients' assets together. We're not a hedge fund. I'm not a big believer in hedge funds because it forces us and encourages me to take more risk. Because in addition to a 1% fee that I'm taking, I would also be taking a 10 to 20% participation fee in your profits, which, by the way, I only get taxed at that if I'm a hedge fund manager at 15%, which is carried interest, which is ridiculous. You heard Donald Trump talk about that as ridiculous, and I actually agree with him on that point. Carried interest is really only good for hedge fund managers because this isn't this is your money that you're putting at risk. This isn't my money. I'm getting taxed on my income. If I take risk in that, I don't think the government should be taxing me at all. But right now they do tax it 15 to 20% on capital gains. However, this is your money. Let's say I pooled all $200 million that Altrius manages together. Well, if I did that, that's your money. That's not my money that I'm putting at risk. And so I get taxed at ordinary income on the 1% that I'm managing, but then on the participation, if we make 10% in the particular year, I get to take, you know, so if we made $20 million, I get to take 10, 20% of your profits and only get taxed at 15%. So I have real problems with hedge funds, again, because it doesn't align our interests, and it encourages me to take a lot of risk with your money, which, again, I'd rather be fired by our clients for not making enough in good years because we're slow and steady. We're not about, you know, and I can't tell you how many prospects, at least once a month, that we send away because we'll meet with them and they want timing strategies or they want something and we'll say, whoa, this is not. Now we try to do a good job of educating our prospects coming in and what we do. Sometimes we take on the wrong clients at the beginning, especially if they're TD Ameritrade referrals. Sometimes the investment consultants at TD Ameritrade will send us the wrong type of referral. But we try to get the right type of client for us, which is a slow and steady approach. Again, we're going to lose money just like the growth guys in the downturn, but the dividends that you get as our clients, that stream of income that our clients get has enabled us to weather. This is the whole behavioral science. I don't believe that markets are efficient. And what people do during these downturns, when the market goes down 50%, people panic, right? Because the market's not even down at all right now, and people are panicking. There's blood on the streets in the high yield market, and people are selling. They're running hard for the hills right now. We're buying, but our clients stayed in there during the financial crisis because exactly their income never changed. Their lifestyle, we kept telling them, yes, your $1 million is down to $800,000 right now. But McDonald's is still paying you a dividend. Pepsi is still paying you a dividend. Your bonds that you own, Bank of America bonds, still paying you. You're still getting $50,000 a year in income. So we're making less money right now because your NAV is down to $800,000. But don't worry about the price decline. If they start cutting their dividend, then that's a problem. And that's why you can see that the yield actually flies higher when the market's going lower. And that's why our clients' income from a percentage standpoint stays steady for them. So all I'm concerned about is dividend cuts, which happens sometimes to some companies, like Marathon Oil cut their dividend this year, or bankruptcy. The particular bond that I'm making the final decision on for you goes bankrupt. That's when we lose money. That's when it becomes a real loss, not a Rent-A-Center type situation. To get into the nuts and bolts of Rent-A-Center, Rent-A-Center is a great company. To me, there's so little likelihood. Here's what I'm looking at. As a fundamental investor, I look at it just like my own business. Not looking at some share to be sold or stock price going up and down. I'm looking at things just like I'm looking at any business. Could be Weyerhaeuser, right? You look at a company or like Rent-A-Center, and you say, geez, they're making $2.4 billion, and then they made 2.3 in 2005. They made 2.4 in 2006, 2.9. They dropped a little bit in 08 during the financial crisis, but not too much. They were struggling in 09. Now, Rent-A-Center helps people, instead of buying it outright, they let people rent to own over time. Could be an electronic device. It could be their furniture. It could be equipment. And they've recently come up with a financing arm, too. They took a hit of $4 million they got into the smartphone business, which was kind of ill-advised. And so they took a bit of a hit on that recently, which is why you'd see. But there's no reason, if you look at their earnings this year, their earnings are still doing fine for what they're doing last year. So why is the stock sold off 50%? To me, there's no rational reason for a stock to sell off that much, other than hedge fund managers and money managers and quantitative programs saying, sell, sell, sell. They missed their earnings. And again, the bond is down. As we know, the bond is down 20%. So what are we doing as value investors? We're not selling like everybody else. We're buying. Because we think that the likelihood of Rent-A-Center going bankrupt is very, very low. And you can look at that. Here's Rent-A-Center's debt. You can see they retired some of their debt here in 2007. And this is what their interest expenses are that they're paying, $50 million a year in interest. But they're making $161 million in operating income after, this is all their revenue for all the stuff they sell. And this is after all their expenses, their people, their sales of goods, and all of their assets. They're still making a nice operating income and profits. So, cash flow guys will talk about EBITDA, but I always believe in you got to pay interest. I got to pay my mortgage, and you got to pay taxes. You got to pay the government. But even after their interest payments and even after their income, you can see Rent-A-Center is making money. Now, things that we always have to ask ourselves, what could change, right? So the world could change. The horse and buggy could change. Things can go wrong for Rent-A-Center where they're not able to pay or make their interest payments. That's quite possible. Things could go really bad for them. And that's where 80% of the companies that we own look like Rent-A-Center. They have earnings after their interest and taxes, and they have operating income. Occasionally we're investing in hope, like a Sears or a JCPenney, or right now energy companies. Because I look at energy over the next 5 years, and I think we'll likely be at $60 to $70 a barrel. I don't know where we're going to be next month, next quarter. You could see just this week with energy prices up 2% in one day and then finishing the day down 1%. That's not fundamentals. That's not your demand. That's based upon Wall Street traders trading the price of oil in the short term. Eventually, we're going to have a short covering rally, and oil prices will get to a regular supply and demand because energy companies are slowing their supply side. They're lowering their inventories slowly over time. Even Saudi Arabia is eventually going to have to. They can make a profit, but they can't be profitable and keep their people fed and on all the entitlements that they have at $40 a barrel. They really want and need a higher price of barrel of oil. So eventually we'll see oil prices more stabilized, and that's why we're holding on to a lot of the energy companies that we own. And I'll talk about some of the distressed issues too, because we don't have too many clients who have distressed issues who are on this call, but we have a few. Most of the clients are, newer money that's been invested in the past year, don't have the deeply distressed stuff or the Radio Shacks or those issues that have gone bankrupt on us in their portfolios. But I wanted just to, talk about, kind of show you what we as fundamental investors are looking at as value investors. And the bond is down 20%, and we look at that as a complete opportunity. We don't think the company's going bankrupt, and that allows you to make an 11% rate of return from the current price of that bond. When you look at, again, that we're able to buy this bond, and it's really a wonderful price for us to buy it at. So I'll take a breath at this point too, since I haven't in like 50 minutes here, and throw it out to any questions you have as we go. I know because sometimes I don't get asked questions as we go. Does anybody have any, or you can send one via chat too if you don't want to yell. None? All right. All right, so I'll keep talking. Okay, so now I'll talk about some of the distressed issues too that are in the portfolio. Where did I put that? Let's see. Let's try to find it here. Here it is. Okay, so let's talk about, well, since Resolute Energy is right below Rent-A-Center and it's distressed, let's just talk about Resolute Energy. So Resolute Energy is in that wildcatting section. They're clearly distressed, right? So Goldman Sachs and large investment banks, they come to Resolute Energy. Resolute Energy says, hey, I want to build a well in the Permian Basin, or I want to buy land in the Permian Basin because we have this tremendous technology now where we can drill sideways, and that's what's driven the price lower too. It used to be you could only drill down. Right now we can drill sideways, and that's created an incredible supply ability. Well, Resolute Energy goes to Goldman Sachs and Merrill Lynch and large investment banks and says, hey, we want to drill a well. We want a wildcat. We want to go out there and, it'd be like me drilling in my backyard. I think there's oil back there or natural gas, and I drill down it and I'm able to sell that, right? And some of you have actually had that happen. Some of our clients who live in certain areas that, they get the knock on the door and an energy company will come in and say, hey, we want to get onto your property. We want the energy rights to what's underneath either coal or whatever else. And we'll pay you to do it. And so Resolute Energy does that, and they get lent money with the expectations at $80 a barrel. Well, we know what happened, right? It was easy for me to call the tech bubble. We never bought Cisco and Intel and Microsoft at 100 times earnings. Companies we own now that pay a dividend are selling at reasonable multiples at 15 times earnings. It was easy for me to call the real estate bubble. We got out in 05. We got out of the commodity bubble in the summer of 08. That one was one of the few times I perfectly timed it. However, I wasn't able to call the financial crisis because that's an emotional event, how you and I feel. And when you have just a crisis of confidence, only the federal government's able to prop up prices and come in. And then secondly, I did not call energy prices plummeting like this because of this technological innovation which occurred, this sideways fracking that I didn't know about, which drove the price from 80 to 40. There's plenty of people saying, hey, oil's going to 20. Goldman Sachs made that call. I really highly doubt that. Could it happen? Yeah, it's possible. Would I put it in the realm of probability? No, it seems to be moving between 50 and 40, and that seems to be the range right now where traders start coming in. You know, of course, right now it's at like 35 or 36 or 37 today. And there's all different types of oil too. You know, you got WTI, Brent crude. And so anyway, this has decimated companies, including financial companies that lent all the banks. Now, when banks were in trouble, when Goldman Sachs was in trouble, and Merrill Lynch was in trouble, and Wells Fargo and Wachovia and all those banks, the federal government and we, the taxpayers, saved them. And it was only that saved a horrific, worse than Great Depression type scenario from happening. In this scenario, the federal government is not going to come in and save the energy situation because they know that ExxonMobil and some of the larger energy companies will make it. And we're buying companies that we think can make money, like we just bought on Friday. We bought Noble Energy. We think Noble Energy can make money at $40 or $50 a barrel, or a SESI. You can see SESI's paying our clients just less than 8% return, and we think that's very low likelihood of SESI going bankrupt. And that this one you can see is not distressed, right? It's only gone down 5%. Whereas the wildcatters are really hurting. They've been cut in half. Some of them have gone bankrupt. Coal companies are done because coal can't compete against oil. Coal can only compete at $80 a barrel. Coal really can't compete at 40. So coal is completely done. And investment banks like Goldman Sachs have said, coal, we're not lending you any more money. The question for us now, and one of the hardest decisions that I always have to make is, do I take the bird in the hand? Do I go out and say, I'm going to take it at $50? I know our position's been cut in half. I know we've lost $170,000. Do I just cut our losses and take the bird in the hand, or do I hang in there and hope that Resolute energy prices recover before 2020, and Resolute Energy is able to make it? Now, if you look at analysts, these are really smart people. If you look at analysts and you look at like a Resolute Energy, today, let's just take a look at Resolute here. You'll see the analysts are really conflicted about this because we economists are guessing at what the price of oil is going to be next year. So when you look at 7 really smart analysts, you can see right now the reason it's a penny stock at 87 cents. They're losing $9 a share. Clearly they can't keep that up. They're on the verge of bankruptcy. A lot of stocks come off of the death knell and make it. Is Goldman Sachs going to lend them money? The question comes down to, Goldman Sachs may have lent them $300 million, right? So think of it this way, is you've lent a guy $30,000, or you lend him $300,000 to keep him going, or they're one of your kids. And do you write off that loan and say, I'm never going to get that money back? Or do you say, you know what, my kid's going to school right now, he's getting his MBA. Do I give him another $100,000 to keep him going so that I have a better chance when he makes a good salary coming out that I'm going to get paid back on my $400,000? And this is the exact determination that investment banks are making right now. They're sitting there saying, scratching their beards, saying, and the reality of it is that they're split. If you look at, this is a very small company, right? This is a tiny micro-cap company. If you look at, there's 7 analysts that cover Resolute Energy because it's on Wall Street. So there's not many who publish their results. Well, of those 7, you can see that some of them think they're going to lose money next year, and some of them think Resolute's going to make money next year. So if you're Goldman Sachs and your analyst says, hey, they're going to make money, you go ahead and give them the extra 10, 15, 20, $50 million along with other investment banks to keep them going. It's kind of like a bank who, do they foreclose on the house and sit there and then have to sell that? Goldman Sachs does not want the equipment of Resolute Energy that they've got across the country. Goldman Sachs does not want to go in there and foreclose on their equipment. Goldman Sachs wants to get paid back in full and then roll that interest, because most companies in America don't have pristine balance sheets. If they do, we're not going to lend money to Apple because we're going to get paid the same thing as we're going to get paid. If we lend money to Apple, we're not going to get paid more than maybe 1/4% or 0.5% than a 10-year treasury. And as you know, right now, a 10-year treasury is yielding nothing. This guarantees your failure in retirement, right? Especially since there's no reason for us to charge you a percent after a 2% return for you to put your money in the bank and tell you, well, you can only take out 1% a year. We have to take some risk to get you to that comfortable retirement. And we're not going to lend money to Apple at, 2.5%, because we know they don't need to borrow money. They've got, billions of dollars that they don't even need to borrow. Most companies in America are kind of like, think of it like a doctor who he's got that $150,000 of debt, but he's making $400,000 a year. And the bank comes to him and says, all right, doctor, we're going to lend you $1 million so you could buy a nice house. And, your mortgage payment's going to be, I don't know, $18,000 a year or whatever that is. I don't know. At current interest rates are low, maybe more. Actually more. It's going to be somewhere like $40,000 a year. Now, the doctor's making $400,000 a year. He can cover his expenses from his interest payments on his college expenses, and he can cover the mortgage on his house, and he's probably went out and bought a BMW, that too. He's covering that interest expense, and he's fine. Now, but if the bank came to him and said, hey, doc, your 5-year adjustable rate mortgage is up. Where's the $1 million you owe us? Doctor would say, whoa, I don't have any assets yet. I just started out. I'm just starting out in life. My kids I could keep paying you your interest payment. That's what Rent-A-Center's like. That's what Toys R Us is like. That's what Sears is like, and Sprint. And most companies in America are like that. They can pay their interest payments, but they can't pay back the loan in full. They need a new revolver at the new interest rate. And this is where we take less risk in the equity markets, buying McDonald's and Pepsi and Exxon. We take more risk in the fixed income markets to get you that nice 5% return from a balanced portfolio. Again, your $1 million could be worth $800,000 tomorrow, but still going to pay you $50,000 a year. So that's always been my philosophy on bonds. So when going back to Rent-A-Center, you'll have one economist who says that this guy who says price of oil is going to be 80, and then you'll have this economist who's saying the price is going to be 30. And the analyst has to take that chief economist, and just to show you something fascinating, I've never seen, usually a larger company like ExxonMobil, it's going to be really tight. I mean, when I say tight, I'm like, analysts are going to be somewhere within a nickel to 10 cents of each other in terms of, because Exxon's steady, right? They're a steady Eddie type company. Or McDonald's is relatively steady. You know what you're going to get out of McDonald's. You know the sales and what they're going to be. And the 35 analysts who cover Exxon are all going to be pretty close to their estimates. Well, look at this. You'll be fascinated by this. This is a huge gap. So the low analysts out of the 24 that are covering, one thinks they're going to earn $2.84 a share. One thinks they're going to earn $5 a share. I mean, that's a $2.20 differential. That is gigantic for an ExxonMobil. So the difference in that is the price of oil. Nobody knows where the price of oil is going to be right now. And you'll get one guy on CNBC who says, hey, the bottom's in, and you'll get some other guy who says we're going to 20. Nobody knows. And anybody who tells you that they do is a liar. Longer term, I think, will be at 60 to 70. And again, going back to, to Rent-A-Center at these valuations, or Resolute Energy for that matter, to go back to the bond that was showing you here. I don't know why I keep losing it. Here it is. So Resolute Energy, what I'm doing with these positions right now is holding them and just saying, you know what, if half of them make it and half of them don't, we're going to make a 30% rate of return if all of them make them. Well, that's not probable, right? But if half of them make it, we're going to make a pretty decent rate of return. We're going to make anywhere from 10 to 12 to 15% rates of return if some of these companies make it. And let me show you the stress test that we put our portfolios through. From that standpoint, what we do is we say, okay, let's look at a regular scenario where we look at 3 economic scenarios that are possible. This will be the last concept I'll kind of talk about here. I don't know why I can't get this stuff. It's graying out on me here. not cooperating. I don't know why it's blank. I know it's like slide 14 or 15. I'll wait till it gets there. Let me show you our stress test right now. So
you think you can hear that?
yeah, I got some feedback going on. Okay, so let me show you first the high yield calculation. And then secondly, just the regular outlook at current prices. I'll pull up the PowerPoint here so you can see it. Okay, so as an economist, we're just guessers. And I sit here and say, okay, what if we have a bear scenario? What if the doomsayers are right and we have a recession right now? And what if the bulls are right? What if stocks do well? And then what's our base case scenario? What do we think is the most probable? Well, you can see U.S. stocks and international stocks have about the same downside risk. We could be here 5 years from now, and we could be down 15% for our stocks, and you're not going to be happy with that. And it's possible. It's not probable, but it's possible. You would be very happy if we have the bull scenario because we would make 60% in U.S. stocks and we would make 80-something% from international stocks, in particular Europe, which is why you can see I've moved more money into Europe because Europe's opportunity cost is very nice compared to the U.S. right now with the same downside risk over longer periods of time. In the short term, again, anything can happen. Even our base case scenario, Europe looks a lot more attractive than the U.S., which, by the way, is why dividends matter right now too, because at regular base prices, the outlook for U.S. stocks isn't that great. Now, I'm never going to buy you investment-grade bonds right now because you make a horrible rate of return in all three scenarios. You make a horrible rate. If I buy you a U.S. Treasury right now, you're going to make a 2.2% rate of return over the next 5 years. At best, if we have a recession, you're going to make a 1.4% on their base case. And if interest rates are rising, you're going to get killed. So we're not buying safe investment-grade bonds right now. We've been primarily the last 6 years in high-yield bonds, junk bonds. And because in a recession scenario, you can see that we still make a decent rate of return. We still get about a 4% rate of return. In a bull case scenario, we make about a 5%. And in our base case, we make about a 6% rate of return. So again, in the short term, your portfolio could be down 10% on paper. But over longer periods of time, 3 to 5 years, we think high yield is the best place to be right now. And why we're investing. Again, we're not buying the farm with high yield. We're not using leverage and borrowing money. This is why we have 80 to 90 of these issues, because we know that some of them are going to go bankrupt. And again, these assumptions assume some bankruptcies, particularly in the recession scenario. So now I say, what if we have just a horrible, horrible scenario? What if happens to us what happened during the financial crisis? And you can see this is a JP Morgan slide. And actually, what happened during the savings and loan crisis, which many of you will remember in 1991, I was coming out of college and going into flying airplanes in the Marine Corps at that time. So I was fortunate to have a job. My other friends were going back to college. You can see defaults were actually higher than they were during the financial crisis. Spreads were a little lower. So we use this scenario. We say, let's say that 30% of our portfolio goes bankrupt. 30%. Rent-A-Center, Sears, JCPenney, Revlon, Ruby Tuesday, Avon, 30% of our companies gone. Because, we're getting some defaults right now. We know we're going to lose some. But let's say 30% go away. Under that scenario, if we lose 30%, you kind of see the math here. Right now, let's say we have a yield, and let's say if you're an existing client, your yield is about 11%. But let's say you're a new client and your current yield is about 8%. And we have a default rate of 30% of the portfolio goes away. And let's say, again, we're like the bank in this scenario, so we're going to get some recovery. Depending on some judge and how many jobs are saved, the average is about 30%, but let's say we only get 20 cents on the dollar recovery, right? Under that scenario, we still make a 1% annualized rate of return. So if you invested $100,000, you still have 104 at the end of that 4-year period of time. And that's a horrible, horrible worst case scenario. I mean, that's really, really stressed. So for us, the opportunity cost, the upside where we can make 5 to 7%, possibly more, and the downside where we're making about a 1% rate of return, which is just like having your money in a treasury right now, safer actually, because with interest rates rising, treasuries are going to get killed. We think this is a great time to be in high yield right now, even though we know the price is going to fluctuate, not as much as stocks, but will fluctuate. Okay, so then what we say is, let's say that, we even put this scenario in to make it even worse. We said, I had Zach, who prepares these slides, and who's our senior fixed income trader. I said, okay, let's not use 30% and 25 cents recovery. Let's use a severe bear case. Let's say we lose 40% of our companies that we own. And again, to see the math, if you invested, $1 million and we put it all in the 80 bonds, and if we lost 40% of these companies, which again, I think is such a small probability, and let's say we only have 15 cents on the dollar recovery, we still don't lose much money. Your total loss would be about 7%, and your annualized loss about 1.7% return. So again, that's a horrific scenario. So as much as I know you hate to see a $10,000 bond go down to $8,000 like Rent-A-Center has done, unless we lose 40% of these companies, we're going to do pretty well. We're going to make a decent rate of return and better than cash, and we have the upside potential where we can make still a 5 to 7% rate of return from bonds. Stocks may outpace that. Stocks could do better than that. Not sure. High yield bonds usually get stock-like returns with less risk. So, again, going back to our scenario analysis, I think that if you ask me what's going to do the best over the next 5 years, I would say clearly Europe. And again, that's the most hated, right? Clearly Europe and our European bonds. This is Nestle, Diageo, Unilever, the companies we own. If I was a betting man, I'd say that's what we're going to buy. Now, again, we only own 0.5% in your portfolio of Nestle, 0.5% in Unilever, 0.5% in those bonds that we own. I mean, again, your stock, to show you my portfolio looks just like yours. I'll pull up my portfolio here quick. The report. I own the same. All my money is invested in my most of it's invested in my company. So post my divorce 7 years ago and went wiped out, I think I've only got about 300,000 in assets left here. So I've managed to build my way back up. But, and this doesn't include our profit sharing plan. If you look at the Altrius profit sharing plan, by the way, I wasn't lying to you. If you look at Altrius' profit sharing plan, which a lot of the money in Altrius' profit sharing plan is mine, but here's Altrius' 401k. So Altrius' 401k is invested in the same U.S. stocks, same international stocks, and the same bonds that you're invested in. Same thing with my my personal portfolio here. And to me, if you look at the stocks that we own, I think that Exxon will do well, and Darden will do well, and JP Morgan and Kellogg's and Pepsi will do well. But my guess is that GlaxoSmithKline and Diageo, which makes Guinness beer, and Johnny Walker Scotch, Smirnoff Vodka, Tanqueray, Bailey's Irish Cream, just high-end distilled spirits. Anheuser-Busch is now an international company. I think that Nestle and POSCO, these companies, international, will likely outpace U.S. stocks. And again, here's my bond portfolio is the same as yours. I own these same. I own Sears, and I own Venezuela, and Cablevision, and Colt Defense, which went bankrupt on us, and Harris, which went bankrupt on us, and Quicksilver, which went bankrupt on Monaco. You can see I usually am a little bit more aggressive with the deep distressed stuff too. So I'll have a little bit more from a percentage of my portfolio than our clients sometimes. But to me, again, I think that you're going to see, it's likely that you're going to see international outpace. However, I'm not going to buy the farm. I'm not going to say, well, we're going to put a lot of mutual funds will try to get their name on Money Magazine and do things, and they'll, that's one of the problems with Third Ave is they had like a 8% position in Harris, and if they're using leverage, they're dead. Our clients, we don't use leverage, and our clients own the individual bonds, and it's a small percentage of their portfolio. So it's a paper loss until it goes bankrupt. And because of that, I'm not going to, we're going to have your portfolio in 75 stocks, both international stocks and U.S. stocks. We own about 35 U.S. stocks that have 1% positions, and we own about 40 international stocks that have 0.5% positions right now. And we're going to own, again, 80 to 90 bonds. And that's a nicely diversified portfolio that over time, we hope will double your money, in 10 to 12 years. But in the meantime, it's going to continue to get you 5% a year in dividends and interest. And that's always our focus, is to get our clients. If you looked at our portfolio as a whole, and you looked at our distribution right now on the entire portfolio that we're managing for our clients, for our unconstrained fixed income, which is all the bonds inside of your portfolio, you'd see that we own inside of there 250 bonds. Again, each of you owns about 80 or 90 distinct. So sometimes we'll own 2 issues of Sears, or 2 issues of Rent-A-Center. I don't know why the current yield's not showing there. Must have done something wrong. But our current yield is very nice right now, and again, our yield to maturity is nice, and we think that this is going to get you a prudent rate of return in addition to the stocks and bonds over time. So again, I'm not betting the farm with any one asset class or any one individual security or any, if you go to Morningstar and you look us up on Morningstar, which you could just Google us too, and you can get a lot of Morningstar information for free. But if you, and anytime anybody wants a research report on anything, on any individual stock, we've got like 8 different. So Morningstar rates us, and here's our global income portfolio, which is our balanced portfolio, and you can see we're 3-star rated. We were 4-star rated. We've had, this year's been a little down, and I really don't care. It's silly for me to try to chase star performance. And our U.S. stocks are 3-star. They just got downgraded from 4. We're really outperforming there. But to me, the star system, it just doesn't matter. More importantly, what I want to show you is that not only are we diversified amongst individual stocks and bonds, you're also diversified by sector. I've been adding to energy recently, so you can see we're at 16.7%. But that's out of 100%. We're not buying the farm with energy. You've got 7% in basic materials, 13% in consumer cyclicals. That's like your Microsofts. 21% in financial services. That's your J.P. Morgans. Communications. That's your Verizon and AT&T. Industrials. That's your Caterpillars. Technology. That's Intel, Cisco, Microsoft. Consumer defensive are your companies that we own, like Pepsi and Kellogg's, and then healthcare companies, which we fortunately have been selling, and utilities, which we don't own right now, other than National Grid, which is a British utility company. So your portfolio is well diversified by sector, in addition to stocks and bonds, and in addition to any security. So I just wanted to show you that also from that perspective.
Jim, can I ask a question?
Yeah, please.
And it has to do with healthcare. Looking at those percentages and thinking about just the demographics of our societies, people are getting older, and there's a whole lot more folks getting into that 60-plus age bracket. Is that not a potential opportunity? I guess I'm looking for just your feelings or your feedback on that.
Yeah, it's a great question. Yeah, that's a great question, Doug. And let me show you. We're value investors again, right? Which you know, and if you look at when Obamacare came out, everybody hated healthcare because they said, oh, you know what, these companies are going to do horribly, and companies like Blue Cross Blue Shield and WellPoint, which is now Aetna, are going to do horribly. And I said, you know what, healthcare companies aren't going bankrupt. We are an aging demographic here in America, and people are getting older, and they're using drugs. You know, that's part of it. So let's look at Pfizer, which we still own. Now, you see me this year, or you haven't, Doug, but our other clients, after we made 120% in Eli Lilly and Pfizer and Merck, we've subsequently, these companies, you can see how Pfizer is now selling at 24 times earnings, and the dividend yield is at 3.5. When we first bought Pfizer, it was selling at like 10 to 15 times earnings. It was really cheap, a lot cheaper. Now what's happened is Pfizer's gone, you know, through the roof, for lack of a better word. And so I've been more concerned about, if you look at, you know, Merck and Eli Lilly, you see that these stocks have done really very well for us. When did Obamacare come out? When was that? Anybody know? It was like 3 or 4 years ago, maybe 5 now. But we were buyers. We thought that, and healthcare, by the way, fortunately, we didn't own much healthcare for much of the decade. If you look at a 10-year chart, look at what happened here. Here's the S&P 500, and everybody hated healthcare. Fortunately, we weren't in it. We were really underweight the earlier part of the decade. Healthcare was going down too during the crisis, so we didn't own a lot of healthcare. But we jumped in Obamacare. We were big-time buyers over the last 5 years, and you can kind of see we've been paid off really nicely. Now the problem is that Eli Lilly, which we sold earlier this year, you know, I sold it early, probably. I don't know when I sold it, March or something. You see it's kind of run up some still here, and Pfizer, which we still own, and Merck, they've all done exceptionally well. And at this point, though, I said, okay, we probably want to own McDonald's because Pfizer, these stocks have gotten so expensive. On the contrary side of that, if you look at foreign companies that we own where we're overweight healthcare, like GlaxoSmithKline, Glaxo's done terribly. Look at Glaxo. Over the last 5 years, it's done nothing. It's flat. It was doing okay. It's gone the other way. So now Novartis, the European companies which are selling to us here in America have gotten killed just because they're headquartered in Europe, which is always silly to me. McDonald's isn't even an American company. McDonald's is a global company. 70% of McDonald's revenues come from overseas. So if it does what a lot of other companies we own, like Eaton and Transocean, have just said, you know what, America, you're taxing us too much. We're going to go overseas. Now, Donald Trump has tried to fight back at that by saying something like, hey, we're going to stop American companies from doing that. You can't really stop it, right? Because companies just say, hey, we're America, you're not even allowing us to take our cash like Apple and bring it into America to pay our shareholders out dividends. So we really like right now to go back to our current holdings. We really like foreign healthcare companies that we own. So going back to Morningstar, you can isolate. The global income encompasses our international, our U.S., and our bonds together. But you can isolate, just our international positions or just our U.S. positions, and you'd see that, from a U.S. position, we're way underweight healthcare right now because I've sold off a lot of the stuff that's just gotten too expensive. And the growth guys might keep pushing it, but if you looked at the sector now, I said, okay, same thing happened with military. I used to fly C-130s, which were made by Lockheed, and everybody said, hey, Obama's pulling us out of these wars. Military companies are going to get killed. Well, we were buying Raytheon, United Technologies, Lockheed, Northrop at 7 to 8 times earnings with 6.5% dividend yields. Then we made 180% Lockheed, we made 160% Northrop. At that point, the prices just got way too expensive at 20 times earnings. It's kind of like what the healthcare companies are at now. So you can see from a healthcare perspective, we're pretty deeply underweight healthcare in the U.S. right now, but not overseas, because overseas we're able to find a lot of value where GlaxoSmithKline and Novartis and the other companies we own, going back to our portfolio, showing you our stocks that we own here. If you look at just our international stocks, so Aegon's a Netherlands insurer, Agrium's Canadian, Anheuser-Busch is now Netherlands. AstraZeneca is obviously a healthcare company that sells to us here in America. So we own AstraZeneca, we own, what else am I looking for here? GlaxoSmithKline, and we own Novartis, and we own Sanofi Aventis, and that's it for healthcare on that side. So those stocks are cheap. Those stocks are, and so you're getting, we've kind of shifted from selling Eli Lilly and buying Sanofi because we're getting a lot more dividend. If you look at, just to kind of show you, here's Pfizer. Now, so we've had all this gain from Pfizer. It's been a great stock for us, or Eli Lilly. Now let's look at Pfizer compared to GlaxoSmithKline right now. So Pfizer's selling at 24 times earnings. Historically, stocks sell at 15 times earnings. Growth stocks will sell at 20 times, and the dividend yield is at 3.5. Contrast that with GlaxoSmithKline, which is selling at 6 times earnings. I mean, people are just selling it because, oh my God, it's in Europe. Europe's in decline. Glaxo's selling to us. I mean, in Bergen County, New Jersey here, Glaxo's, that's the SmithKline family. To me, and by the way, what was Pfizer's dividend? Like 3%? Glaxo's paying you, our clients, double what Pfizer's paying, and it's 60% off the price of Pfizer. And I'm in the only business when everything's 60% off, nobody wants it. If it's like I tell Annie, I'm like, when everything's 60% off, everybody wants it. But in my business, if something's 60% off, everybody's going, oh my God, don't get rid of it. And our clients should be calling us, thanking us when prices go down. But that's not the way. That's not the way the stock market works, right? Everybody's nervous. But Glaxo, here's the other thing about Glaxo: they're making $6 a share. They're only paying $2.33 to you. Their earnings could get cut by 20, 30%. They still have room to grow their dividend. Not to mention, when you look at this company, a company like GlaxoSmithKline, where the stock price is not done well, over the last thing, but from the standpoint of the earnings of the company, where they have, I got to log back in here. A CEO doesn't really have control, as you know, Doug, over the price of the stock. That's up to the market in the short term. It's always a voting machine in the short term, but it's a weighting machine over the long term. Eventually, stock prices will follow earnings. And again, as a value investor, it's painful. It's painful to sit through losses when you see the price going down. But when we can own a company like GlaxoSmithKline that continues to grow, look at the revenue growth of Glaxo. You've got tremendous sales growth, again, over longer periods of time. It's declined a little bit here in the short term, which has pulled it off, but they've done a good job of mining their bottom line, which is why, again, this is more of a distressed company right now that we're moving into, and we think it's a good buy. But you look at this company, and it's done a good job of managing it. So it's getting hurt a little bit by the translation because, again, it's an ADR, so it's priced in dollars. And sometimes currency fluctuations will hurt companies. Glaxo should be helped now, right? Because not so much Glaxo because it's British, but other companies that are on the euro should be helped more by the stronger dollar and the weaker euro. So we love these kind of companies that in the short term, the stock price might not be going anywhere, but if they can continue to mine their bottom line and eke out nice earnings, and they're selling it at cheap multiples, same thing with like you look at like a company like Cisco or Intel that continually, Apple has just been gangbusters from earnings, and these are companies we couldn't. If you look back at Microsoft, which again was painful for us for time to own, we've now been really nicely paid by Microsoft, both from a dividend and interest. But we're not going to buy Microsoft. Look at Microsoft's PE ratio here. There's no way we're buying a stock that's selling at 100 times earnings or 50 times earnings way back in the early 2000s. But when I could pay 9 times earnings, 10 times earnings, 11 times earnings for Microsoft that has a monopoly, and oh, by the way, they didn't pay much of a dividend back here, but now they're paying nice dividends, and they've continued, they weren't paying any dividends here. You can see that they've increased their dividend now for, 10 years in a row, and, they were making, $2 a share and early, and today they're making $10, $11, $12 a share. They've more than, 6 times their top-line revenue, and their bottom-line earnings has been really nice, too. They've more than doubled and half their bottom-line earnings. So this is a wonderful company we own, has a nice dividend. Even at current prices, it's starting to get a little pricey for me, so don't be surprised if you finally see me sell Microsoft if it gets too out of whack. But for years, we suffered through with the stock going nowhere, and finally it's broken out. But all the way, it was paying our clients a nice dividend. It was a really long answer to a very good question, but I hope it kind of gave you an idea of what we're doing from. I
certainly appreciate that you answered it. For those who care, the debate's going to start here in a little bit. But I wanted to offer, if I may, an editorial, because I've only been a client for 6 months. And while Carol and I, like probably everyone on this call, pays for results, I think that the quality of your communication, the quality of your team, and the addition of Chris reinforces the quality of our decision to move our most of our net worth into the hands of Altrius. So this is not a paid advertisement, but I felt the need.
I'm gonna have to send you another Christmas gift after that. That was
No, sir. No, just keep finding a way to make us money, and it'll all be good. But as only a 6-month client, you all have exceeded our expectations so far, and keep up the good work.
Well, thank you. And all you've done is lose your money so far, too. And I always feel horrific. And if you look at this call, it's a lot of times it's the newer clients who are on them, too, because it really takes time to kind of show the power of our dividends and interest. And really, if you look at it, that was really kind of you, Doug. Thank you. It's always tough suffering through, especially at the beginning of a relationship, because you don't really see the power of that dividends and interest yet and that compounding. But just to show you in real money what it does, if you look at our master, which is all of our clients, and you go back 10 years ago to 2005, and back then we were only managing, let's see how much money we were managing back then. And we've grown prudently, and we continue to try to grow prudently and getting 1 to 2 new clients a month. And thank you for the referrals that you've given us over the years. And that's how we grow. We find that our clients who we like and whom we like spending time with always refer us to nice people like themselves, and that's how our firm has grown. And we can't really manage more than $1 billion and do what we do on the bond side. So at that point, it would be the very difficult decision to say, hey, we can't let in any more clients. We'll cross that bridge when we get there. We have years before we ever get there, probably decades. This thing's calculating 10 years of data here, so it's crunching these numbers. But I just wanted to show this. Yeah, I was only managing $55 million 10 years ago, and today here we are at right around 195 or somewhere. With the mutual funds and other stuff outside, we're right around 200 million. And I just wanted to show that this is the most important thing. This is a conglomerate of all of our clients. They put 200 million in, they've taken 100. That's some clients, because our clients take a lot of money out. They're retirees, they're living off that income. But and we've made them, 38 million, or not that much over the last 10 years. It's been a rough decade. But of that 38 million, especially over these last 2 years, 50 million has come from dividends and interest. So if we were buying stocks that weren't paying dividends, and again, the S&P, hasn't been great in the last decade, $50 million of the 38 after our fees or before our fees over the last 10 years of the total return has come from dividends and interest. And our clients who sit down with us, who have been clients for a decade or 8 years or 9 years, they start to see that it usually makes up between 60 to 80% of their total return actually comes from dividends and interest. And people forget about that. As much as I love Warren Buffett, Berkshire doesn't pay a dividend. Now, Warren uses that dividend to buy other companies, but I want him to pay our clients. So as much respect as I have for Warren, and we've done, actually, our U.S. stocks have outperformed him over the last 5 years, and I always have there's a Berkshire, I always show us versus Warren if you look at our presentation studio. And by the way, anybody who wants to get off and jump off to the thing, go ahead. If I like to show our presentation studio of like us versus Warren. But the problem with Warren Buffett's stock is it doesn't pay our clients a dividend, and you have to sell shares of Berkshire Hathaway in order to fund your retirement. Whereas with our strategy, you don't have to ever sell a share of Microsoft or Exxon or GlaxoSmithKline if you simply stick to the income that's generated from those stocks. And over time, stock prices will eventually appreciate to hedge inflation risk and hedge the taxes that you have to pay to the U.S. government. So I think Warren beat us over a 10-year period, and we've got him over the last 5 years. I think is the strategy. Again, we wouldn't throw all of our clients in U.S. stocks either. We want to make sure you're diversified with bonds to dampen volatility and international stocks too. But I just like to show, since he's the Oracle of Omaha and he's always touted as the most brilliant man around. I'm not saying I'm as smart as Warren, but it's sort of you look at the last 5 years. Yeah, I mean, so we've beaten Warren pretty good. He's made 9.5% over the last 5 years. We've made 12. And oh, by the way, his standard deviation is 13, which means he takes more risk. Ours is only 11. So his alpha is good. Warren's been good. He's got a positive alpha. He's been smart. But we've been a lot better. Our alpha is huge. And again, I don't know I'm going to beat Warren over the next 5 years. And if you look at Warren over the last 10, he's outpaced us. He's done 9%. We've done 7.1. But again, he's taken more risk than we've taken. So the Sharpe ratio is one of the best ways to judge a portfolio. Bill Sharpe won a Nobel Prize and what he does is he takes the return over the standard deviation minus a riskless return. And you can see Warren Buffett's Sharpe ratio is exactly the same as ours over the last 10 years. And, and again, I'm not saying I'm smarter than Warren Buffett, but our strategy, you're getting 4% in dividends from us, you're getting 0 from Warren. Some years Warren will beat us. If you look at year after year, some years Warren will beat us and some years we'll beat Warren. But we're not investing in Berkshire for that reason. Is we're not getting dividends and it can't fund our clients' retirement. So, I can promise you if you email me at 11 o'clock on a Friday night, you're going to get an email back though. I can promise you this diligence that I'm showing you when we're analyzing companies is continuously going on in my head. And when I hear of a crisis going on, I'm usually thinking that's an opportunity that we can take advantage of for our clients when there's panicking going on. And those are usually the types of stocks that we're buying. So with that, I really appreciate everybody joining us tonight. And I'll stay on for any questions that you may have too. I'll stay on as long as you want. So are there any other questions for the group Anybody has one that they might think I didn't cover tonight that they're interested in?
Yeah. Hey, Jim. It's Marilyn.
Hey, Marilyn.
How are you?
Good. How you doing? Merry Christmas.
Listen, we appreciate the update, and you know me, I'm a nervous Nelly, but I've kind of learned over the years that what you say is actually what happens. And just wanted to wish you Merry Christmas, and I must go get another glass of wine so I can see the Donald.
Excellent. Well, thank you, Marilyn. I'm not always right. I was pretty right on gold, though. I'm glad we haven't been investing in gold when it was at 1,900. And again, gold's going to get killed as interest rates start to rise too. So you don't see us investing in gold right now. Although we are lending money to gold miners like Anglo Gold and some of the others because we don't think that they're going to go bankrupt and people keep buying gold and they can make money. Like Anglo Gold can make money at even $80 an ounce. So, or excuse me, $800 an ounce, not 80. But thank you, Marilyn. Enjoy your wine and enjoy the debate.
I certainly will. And you guys too.
One glass of wine may not be enough for the Donald.
Boy.
That's true.
Bye, everybody.
Take care, Marilyn.
Okay, bye.
Bye. Any other questions out there? You too, Lee. Merry Christmas.
Yeah, Merry Christmas to you.
A pleasure.
I tell you that Tara really helped Rose the other day because she's, that glass half empty kind of person. And when I asked Tara to show her the dividends and the income side of it, it really clarified it for her. I think she feels a little better.
Good. It's easy to do in times like these too, especially when you see the portfolio value going down 5-6% in a year like this year. When international stocks are dropping and high yields, the bonds are dropping, and our U.S. stocks are still relatively flat. I get it, and nobody worries more than me. I liken it though to kind of like when I used to fly airplanes, and a couple of times, we had fire, and somebody would scream fire, and I always remember that as scared as I was, I had to try to stay calm in front of the other Marines and try to keep your head and act calmly. And it's the same thing with the market, and especially if you look at this this evening, it's all men who are on the call. We had Marilyn was on there, but it's mostly we men who feel like we have to do something, we have to fix something, and women tend to be better investors. They kind of hang in there. They take a much longer term approach. They don't worry about Jim Cramer screaming about something, or they tend to be better investors usually in longer term, and that's we used to say the first, unlike a jet pilot who you eject, you try to do something and then you eject to get out. With a C-130, our first emergency procedure was to sit on our hands and not do anything rash and to think. And I try to do the same thing in investing. Is the first thing I try to do is, all right, sit on my hands and not react to what's going on. We're long-term investors. Does this really change how many hamburgers are consumed in China? Does this change how much Nestle's chocolate is consumed in Latin America? Or, how much healthcare is consumed in London? And if the answer is none, we've been through so many crises, from bird flu to everything else that have been out there, that the media tells you it matters in the short term. And the reality of it is longer term. I can honestly say the only thing I really worry about is a nuclear weapon getting into the hands of a terrorist or a terrorist nation, because that's something that could derail an economy. Now, the good news is I think we're 5 to 10 years away from that technological ability to be there for them, because it's hard to move a nuke. And are we going to have continued terrorist attacks? Yeah, I mean we've had those throughout history. Israel's been dealing with it for decades, and we'll still have that here in the United States. And as horrible as it is on a one-to-one basis, and I just went to the 9/11 memorial 2 weeks ago with Annie, and it is horrific. I mean, I get choked up just thinking about it now, walking in and you see in that ground, and it's truly hallowed ground. But we're a resilient economy and a resilient nation, and we came through that time, and companies still earn profits, and we as shareholders can profit by that, and we can collect our income and get that dividend and pay ourselves while we're waiting for that price to recover.
Yep. All right. Well, I'm going to head off here and go watch this circuits for a while.
Yeah, it should be fun. All right. Well, good night, everybody. Any other questions out there? Night, Lee.
All right, good night.
Anyone else? Nope. All right. Well, thank you very much. I appreciate you tuning in tonight, and enjoy the debate or the History Channel or whatever you're going to watch tonight or read there yet. And have a very Merry Christmas, Happy Holidays, and a Happy New Year. As always, feel free to call your personal advisor, Tara, or Chris, or call myself anytime you have a particular question about your portfolio or financial planning need. All right. Thanks a lot. Thanks for joining us tonight.